everybody, to another Mike with Mike, and it's time to talk taxes. Yes,
Taxes.
everybody's favorite subject, right? Tammy,
Some people love it.
and Tammy is one of them. She's one of the 10% of the world that absolutely loves taxes. Tammy Becker, Becker Tax and Bookkeeping LLC. You always have to have the LLC because that's a tax thing. But we're talking today about charitable donations. Obviously, the United Way are your favorite charity. It has to be a qualified charity. That's the first thing that's important,
Right,
correct?
and if you're ever not sure, you can go to irs.gov and pull up their list of charitable organizations.
So it's
So qualified, they have to be a United States organization qualifying for that charitable exemption.
and it's typically, I mean, most of the time if they're asking, they are.
Yeah.
What's not though is like if you're helping maybe a benefit or something like that, and that's where it gets a little questionable.
So benefits, a lot of people ask us if they can take a deduction for giving to their kids, and my whole thing is it has to be a charitable organization, not a charity case.
Correct.
So kind of look at it that way. Benefits, yeah, they say if you're giving directly to that benefit, unless they went through the steps of establishing a charitable organization, those do not qualify.
So now we're getting to near year end. We have this conversation every year. Bottom line is there are still some things you can do, and charitable giving at the end of the year can really help.
Correct, yep. So in order to take, for the most part, a charitable deduction, you have to be able to itemize on your taxes. You kind of flip through your tax return. Do you have a Schedule A there? Usually if you own a home and you've got mortgage, interest, and property taxes, you are probably itemizing. If you're a person who's in a type of job where you've got a lot of job-related expenses, salespeople, truck drivers, things like that, you're probably itemizing your job-related expenses. So if you have enough to itemize, charitable organizations deductions will help you.
And you have to give it before the end of the year. So you actually, and while neither one of us proposed to put tons of stuff on credit cards, you could put something on a credit card on 12/31. It would still count. You actually wouldn't pay for it until the next year.
Because then you're not paying the charitable organization, you're paying your credit card. The charitable organization's already been paid if you put it on a credit card on or before December 31st.
Okay.
If you write out a check and put it in the mailbox December 31st, you're good to go there also.
Right.
They kind of look at if you get past a check, if it doesn't get cashed before like the 15th of January the following year, then they might think it's a little bit fishy and question the organization as to whether it really was a prior year or current year.
And good organizations get those, I mean, literally they're running to the bank on the 2nd, the 3rd, the 4th, because they know that. I mean, and I can tell you, the United Way, we will get the money in right away. We want the money. But that's pretty much any charity, any church, anyone. They know those rules too.
Correct.
And so that they want it. But it can have impact. I mean, it can, if you can pull yourself down a tax bracket if you're on the edge. It's a lot of neat, so it can really have some impact.
Right. You could, be in a 25% tax bracket, and maybe that extra $1,000 or $250, whatever, might pull you back down into from a 25% down to a 15% tax bracket kind of thing.
Right. So that's huge. Now, another great way to do it, and especially after a year where the stock market's been up so much, is appreciated stock.
Yeah, appreciated stock is probably one of the better ways to give charitable deductions, because that's not, it comes off of the front of your tax return. You're giving that stock to the organization. The organization will actually cash in that stock to get the funds from that stock. So it's not even showing up as income on your return. Whereas if you cash the stock yourself, you've got that $1,000 of income, and then you have to itemize to take that $1,000 of deduction. And there's certain things on the front of your tax return that are affected by the income that don't get affected by the deduction. So.
But you still do get the deduction if you itemize. I mean,
correct.
So,
yep.
but like you said, the sales, by not having it, helps you, and you're really sort of donating with discounted dollars. So if you have a stock that has a cost basis, that's what you paid for, of like $10. And bottom line is, if you have that cost basis that's $10 and you sold the stock for $50, there's one of those that sort of is in Winona that might be not slow but fast, that has a whole bunch of people that have that much gains from like a Fastenal.
yeah.
Bottom line is, you give $200 really that you spent, but they're gonna get about $1,000 donation.
Right. The other thing about appreciated stock is if you don't know what the cost basis is of that stock, you've got a problem at tax time. So donating the stock for them to cash out, you
Great
get a
point.
deduction for the fair market value at the time of the donation. You don't have to be like, oh boy, I bought that stock in 1986 and I don't remember how much I paid for it.
Right.
Or maybe it's these baby bells that have split off all over
9
the place.
million times.
No clue how much the
Right.
basis was, yeah.
And mutual funds can work too.
Correct.
Now, all of these though are not IRAs. That's what we need to talk about, non-qualified.
IRAs are totally separate kinds of money.
Yeah, now you obviously don't want to take money out of an IRA under 59 and a half, because if you take it out of there and give it to a charity, you're still going to be paying penalties.
Correct, yep.
However, there are some really cool rules if you're over 70 and a half, as far as giving your either required minimum distribution or just extra money to a charity.
Yeah, so if you're 70 and a half, you're subject to those required minimum distribution rules. Oh, you gotta take money out. Maybe you don't want that money. A lot of people notice that if they have to put that money on their tax return, it's subjecting more of their Social Security to taxation.
Correct.
So if you make a qualified charitable distribution, you have that money go directly to the United Way or any other charitable organization. It doesn't even come on your tax return. It's zero taxable dollars. So we're saving the possibility of other income being taxed that way.
That's really great advice.
If you can't itemize, it's saving you money there also. And that's a lot of people who are 70 and a half don't have mortgages and well, they got property tax. They don't have mortgages on their homes, so they're probably not itemizing unless they have a lot of medical expense.
Right.
So if you do a qualified charitable distribution, the way that we like you to do it is to have your, what do they call it, your trustee
Right.
send it directly to the organization, and
The
then
IRA, send it,
the
she's
IRA
being technically
distribution.
correct.
Mhm.
So if you're at XYZ funds, you want XYZ funds to make the check directly to the charity and
Right.
keep you out of the middle. They can send you the check to hand to the charity, but
Right.
they want the United Way listed as the payee.
Right, because then your 1099 doesn't show a normal distribution, which the IRS thinks is a normal distribution. They have it specially coded
As a charity.
that it was a qualified charitable distribution, not taxable.
And really quick, because we're a little over time, if you're thinking about giving a legacy gift, a long-term gift, again, those are IRAs, those qualified plans are a great way to do
Probably
it,
the
aren't
best
they?
way, yep, mhm.
For like estate planning reasons. So, because
They're taxed at a higher rate than non-IRA funds, which if you're giving stocks or mutual funds, those are going to be capital gains taxed at different rates.
Well, thank you so much, Tammy. It's always fun to talk taxes. Look at she's smiling. She's getting really. You're just excited for like what about January 22nd,
Yeah,
January
somewhere between the
23rd.
20th and the 25th, things kind of pop.
And the other advice, everybody, if you're watching this and you get things from mutual funds, brokerage accounts, don't do your taxes too fast. They're
not-
taking a lot longer. It is not January 31st anymore. It is February 15th, and sometimes it's March 1st. Take your time. You don't want to have to file twice. If you want to give money to the United Way, which is why we're here, and we really hope you do, because we take care of over 111,000 times last year we touched folks, which is a lot. It's great agencies. We take care of a ton of folks. Give the office a call, 608-796-1400. I would guess talking to Lori would be the right person about stock, or Terry, who answers the phone, will get you to the right person. If you have any questions for taxes, call Tammy. She loves questions. Thank you very much, everybody. This is Mike with Mike. We'll see you again next time.
Thanks.